Warren Buffett, the most successful investor of our lifetime, made a massive move in his position in Constellation Brands, and I can't wait to reveal it to you. So, is Constellation Brands a buy at 165 a share? And if you want to build indestructible generational wealth, is Constellation a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis of Constellation Brands based on their recently reported 2024 results. Trading at 165 per share, I have a buy rating on Constellation stock. In my research, I discovered 6 things that got me very excited and 5 red flags to watch out for with Constellation Brands. So what did I discover? What's my value for Constellation Brands stock? And what is an ideal entry point should you decide to become a Constellation shareholder? I'm Ken Freeman. I have 20 years of Wall Street experience in investment banking and hedge funds, and I train analysts at the top banks on Wall Street. In this video, I will cover Constellation's recent results and what everyone is missing, what I think about Constellation stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. If you're enjoying this, please smash that like button. While Constellation Brands beat analyst estimates for revenues and earnings, the stock dipped on a softer outlook due to several transformations that will hurt short term and help longer term. Let's cover the red flags first. Every single Corona, Modelo, or Pacifico you drink is brewed at just a few plants in Mexico. If weather, politics, or construction delays hit those sites, U.S. shelves could run dry overnight.
We're an American company. We're invested in Mexico because we are selling authentic Mexican brands. These are not brands in the same way that you're not making champagne in the United States, or you're not making tequila in the United States, or you're not making New Zealand Sauvignon Blanc in the United States.
Over the last 5 years, the wine and spirits business has gone from 32% to just 16% of overall sales. Management has been focused on moving towards higher-end premium brands, which should bear fruit next year.
We expect significant improvements in the performance of our wine and spirits business beyond fiscal 26, following the anticipated closing of the 2025 wine divestitures transaction that is primarily centered around the sale of the remaining mainstream wine brands in that portfolio.
A fresh U.S. tariff on imported canned beer could shave $1 on every 12-pack or squeeze margins if Constellation has to eat the cost. Management has already cut profit outlook for fiscal 2026 because of the duty.
Our main involvement has been around the whole aluminum tariff. And then you have, obviously, the tariffs related to our wine business from both Italy and from New Zealand. We're trying to keep our focus on what we can control, and we don't control that issue.
Constellation invested $4 billion in the Canadian cannabis company back in 2018 due to the tremendous growth opportunity. This has been a horrible idea. After multiple impairments and poor results, this experiment has gone up in smoke. When you are a beer, wine, and spirits company, stick to what you know and avoid the shiny objects. Rules for life. Young adults under age 35 are drinking less and less frequently than 2 decades ago, but this is counterbalanced by an increase in drinking for those age 55 and older. This has driven the focus towards high-end, high-growth, high-margin premium offerings for the company. Here's what got me really excited. Constellation is the #1 brewer and seller of imported beer in the U.S. market. Modelo Especial is still the #1 beer in America by dollar sales, while Pacifico and Victoria were the top 2 fastest growing major imported beer brands. Frankly, Pacifico is my go-to whenever I'm having Mexican food.
And there's no beer of size that has the growth profile that Pacifico's had. It was up 16% last year.
Construction of a brand new modular brewery in Veracruz, plus expansions at Nava and Obregon, boost capacity and diversify beyond a single site. More plants mean fewer headaches if one facility hits a snag.
As we continue to invest primarily in the modular development of our 3rd brewery in Veracruz and modular additions at our existing facilities in Mexico.
Products like Modelo Spiked Aguas Frescas and Corona Non-Alcoholic landed in one of the fastest growing selling lists of their categories. Fresh flavors keep younger drinkers in the franchise and open new sales beyond beer.
We remain focused on driving distribution gains, on launching disciplined innovation, and on deploying incremental marketing investments to support the growth of our beer business, all while continuing to deliver best-in-class operating margins.
After selling off low-end labels, the wine unit now leans on high-end names like Robert Mondavi, The Prisoner, and Kim Crawford, which carry higher margins. Management expects this premium portfolio to generate higher growth and higher margins next year.
We expect significant improvements in the performance of our wine and spirits business beyond fiscal 26.
Famous value investor Bill Miller, who beat the S&P 500 for 15 consecutive years, used to look at 5 and 10-year lows as a stock screener rule. Constellation is trading at a 5-year low, so we're presented with a juicy potential opportunity.
Take it or leave it.
This is what everyone is missing. If you invested $1 in Berkshire Hathaway at the outset, it would be worth over $55,000 today, and you would have beaten the S&P 500 by 140 times.
That is a big number.
Buffett doubled his investment in Constellation Brands, spending nearly $1 billion to buy 6.4 million more shares. When Buffett makes a big move like this, it always catches my attention, and it should for you too. So what do I think about Constellation stock? Let's cover that next. When I look at any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. The company has done an excellent job managing working capital, which consists of accounts receivable, inventories, and accounts payable. We measure this effectiveness via the cash conversion cycle, which shows how long it takes to sell inventory, collect from customers, and pay suppliers. A lower number means faster velocity, and this shows that the company is really managing working capital effectively. The company has reduced debt by close to $1 billion since 2022. Cutting debt and using cash from operations shows solid fiscal management. While retained earnings has declined from 2020 to 2022, it's back on the upswing. Increasing retained earnings means the core equity value is growing, which we want to see. So what's the takeaway? Despite reworking its portfolio to divest of craft beers, cannabis, and low-end wine brands, the balance sheet is stable and the move towards premium offerings is starting to show. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. While we don't see the rapid growth that we typically see with a tech company, growth is steady and consistent without much volatility. This makes it much easier to model and makes intrinsic value easier to predict with more certainty. When making beer, wine, and spirits, input costs fluctuate constantly, and they can be very hard to manage. So we look at gross profit to judge the effectiveness at managing these fluctuations. Constellation Brands has done an excellent job maintaining gross margin above 53%. While there was a post-COVID dip, it has been on a nice upswing since 2022. 2 sizable impairments occurred in 2021 due to Canopy Cannabis and in 2024 due to the wine reshuffling. Impairments are write-downs of previous acquisitions, and we don't like seeing this. The good news is that instead of throwing good money after bad, management has decided to pull the plug in order to adapt to the changing market and position the company for solid future growth. So what's the takeaway? Solid and consistent growth, margin expansion, and divestiture of poor performing investments position the company well for future growth and prosperity. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Free cash flow has remained steady over the last 5 years, which helps us with our valuation because it's going to make future cash flows easier to predict. Having made over 20 acquisitions and divestitures over the last 5 years, the lack of volatility in free cash flow is quite remarkable and rarely seen. Capital expenditures are investments in property, plant, and equipment, the seeds of future growth. CapEx is steady and growing methodically, and with the build-out of the Veracruz brewery over the next 2 years, more capacity will be coming online to manage growth moving forward. Constellation Brands has returned $7.6 billion to shareholders over the last 5 years, and they maintain their dividend through COVID. While shareholders haven't seen price appreciation, the company has still managed to return capital, which is a very positive sign. So what's the takeaway? Steady and growing free cash flow, methodical capex, and capital being returned to shareholders, all positive signs for a company ready for a prosperous and abundant future. So what do I think about Constellation Brand stock and what should you do? I'll get into that, but let's go through my valuation first.
Let's see it.
On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. That gives us an intrinsic equity value of $39.9 billion. We divide by the current shares outstanding. It gives us an implied share price of $224 compared to the current share price of $164.49. That's a 36% discount, which is a solid buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us with a margin of safety. I'll give you my thoughts on how to play Constellation Brands stock later on in the video. So what does Wall Street have to say about Constellation Brands? Let's cover that next. The consensus among analysts is that downside is limited and negative news is already priced in. Wells Fargo has an overweight rating with a target of 196. They say that despite near-term headwinds, Constellation's liquidity and guidance lift merit conviction, and downside is limited. RBC has an outperform rating with a target of 233. They highlight industry-leading volume growth in the beer segment and vast runway in high-end wines and spirits as reasons for their outperform rating. Goldman Sachs has a buy rating with a target of 260. They said that premium spirits momentum and resilient beer pricing underpin their optimism. Constellation Brands' cash flow profile remains best in class. CapIQ gives me a sense of how other analysts on Wall Street view the company. 25 analysts cover Constellation Brands on Wall Street. The target price is from a low of 170, which is a 3% increase, to a high of 300, which is an 82% increase. The median is 210, which is a 28% increase. The overall rating on a scale of 1 to 5 is 1.96, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, as a result of Buffett's doubling of his stake and this analysis, I currently do own shares in Constellation Brands. If you decide to buy Constellation Brands and become a fellow shareholder like me, I'll tell you exactly how to build a position, which I'll reveal shortly. Back in April, the company repositioned its wine and spirits business, divesting of mainstream labels to double down on higher growth, higher margin brands priced at over $15 per bottle, and that is aligned with consumer-led premiumization trends. Q4 results highlighted a meaningful sequential acceleration in on-premise volumes, places like bars, restaurants, and duty-free, signaling a post-pandemic hospitality revival that could drive outsized beer segment growth in 2025. The 2024 10K outlines plans to expand omni-channel capabilities and extend into select international markets, laying the groundwork for incremental net sales growth beyond fiscal year 2026 as direct-to-consumer travel, retail, and e-commerce accelerate. Constellation Brands hit a 52-week low of $159.35 in mid-June 2025, and it's up 3% since then. My model shows a value of $224, which is a 36% discount at current levels. on Wall Street, we buy with a margin of safety of at least 20%. So Constellation Brands is a solid buy at current levels. And if you do decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. Constellation Brands owns Modelo, the #1 selling beer in America, and it has one of the fastest growing brands in Pacifico. They have divested of low margin craft beers, run of the mill wine brands, and spirits to focus on premium high margin offerings. With Buffett doubling his stake and improving metrics all around, I am very excited for the future of Constellation Brands stock. If you like this and want to see another in-depth stock valuation, check out my Alibaba video here or my Intel video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.